Okay, fellow traders, back again with another market review on gold, showing you my 5-minute strategy, how it works, what you need to look for, how you need to mark up your chart. First things first, as always, we are using ICT concepts, so make sure your chart is set to New York time. Secondly, what you want to do, you want to highlight 12 o'clock midnight, and you want to highlight 7 a.m. so that you have the London session and the New York session separated. Everything on the left hand side of 7 a.m. becomes your London session, and what you want to do in your London session, you want to highlight your high and draw it out into the future. London session low, you want to highlight it and draw it out to the future. Any breakers or any fair value gaps, you want to highlight that and draw it into the future. Reason being, price is going to use these points to grab onto, to bounce and work its way, either swing low or swing higher, as I've stated before. And then so right here we have a breaker. I think I'm drawing that wrong. Take it back. Low, high, high. Breaking market structure right there. Draw it out to the future. Boom. Have that. We highlighted. High, low, high. Breaking market structure right there. Draw it out to the future. Why do we draw these points? Because price is going to draw on and use it. So at 8:30, price is going to do this. Always. 90% of the time. It's going to perform a Judas swing and sweep liquidity before it actually performs the move that it wants to perform. I'm going to say that again. It's going to perform a Judas swing at 8:30. That is your first trade if the range is big enough. But from here to here is not a big enough range. If you watch my other videos, I'm always showing the first move, how you could have gotten in, how to execute. But this was too short, so does not entice me at all. Not worth it. The second move happens. We have a high, we have a low, we have a higher high. Price is crossing a high, and a low. Where's the break? The break is right there. Right here. Right there, there's a break in market structure. What does that tell you? What does that mean you need to do? So if this is happening in real time, when price wakes up there, you can get in. When price wakes up a little bit higher, you can get in. Where's your stop? Your stop is right there. You apply short position, entering there, stop there. What are you aiming for? You are aiming for the low. Why are you aiming for the low? Because it was a liquidity point that was left in the London session. If there was a fair value gap that wasn't touched, or there was a breaker that wasn't touched, you could have entered there. But look at what we did here. We drew out this red candle right here because when price broke above, we made a down move and then continued to trade up. Why is price doing that? So that when price trades back down again, it doesn't need to come all the way down here. It's made a point where it can just put its foot on and then step and keep going back up again. If you get the analogy, keep up with me. I'm trying to keep these videos as short as possible so that they're easy to digest, and if you want to watch it again, just slow it down and watch it again. The second move that you could have been a part of, I like to draw this out so that people keep up with me, because this is how price, the way that I'm drawing it out now, this is how it looks in your textbooks and whatnots, or these diagrams that you are watching. And the reason why you cannot apply that is because you're not doing that when you are studying. And how are you studying? You are back testing. So you made a low, made a high, made a lower low, made a high, but is that a break in market structure? Does that say that you can go in? No. But why are we looking for higher prices? We've just swept the London low. So what does that say? Anytime we sweep liquidity, it doesn't mean anytime we sweep liquidity. London session high, London session low, previous day high, previous day low, and you can take this if you're looking at the monthly chart. Monthly high, monthly. If you're looking at the weekly chart, weekly high, daily chart, etc., etc. We are looking at the 5 minutes. So anytime we sweep liquidity, we are anticipating that we are going to sweep liquidity on the opposite side. Why? Because price is not going down all the way, but it's trying to work its way up into that same range where it just swept. So we anticipate. Made a low, made a high, made a lower low, made a break in market structure. We highlight the break. The way that it looks here, it may not look like that for you here, but on the 1 minute chart, price is fractal, and the diagrams that I'm drawing right here, low, high, lower low, you see, high, and then we have a low, a high, a low, a low, then we have a break in market structure right there. And we have a fair value gap, which has been highlighted. See how it all comes together? And right there is your long position where you could have entered. Boom. On that fair value gap, where are you putting your stop loss? Agreeably, there on the lowest low. But once you get a feel for this, I always like to put it on the bodies, right there on the bodies. But if price went lower and dug deep, I was going to measure that long wick and put it halfway, because why? That's consequent encouragement. What is that? Check out ICT's concepts, because that's what I'm utilizing right here. And what was I going to aim for my TP? I was going to aim for the high of the London session, because why? We have created a bullish breaker, which means in a time where we had just swept the liquidity on the downside. So what is there for us to do, or what can the market do then? Search for liquidity on the upside. And what is the high that we created in the London session? Aim for that. Don't be greedy. Always go for low hanging fruit. That's that.